Housing has long been seen as the safest place to park wealth, trusted by families, banks, and governments alike. That trust shaped how people borrowed, saved, and planned for the future across entire generations. Recently, however, something has shifted beneath the surface. Prices remain high in many places, yet confidence feels weaker, transactions are slowing, and uncertainty is spreading quietly. To understand why housing no longer feels secure, you have to examine what that sense of safety was really built on. For decades, housing was treated as the most reliable store of wealth available to ordinary households, a physical asset assumed to be protected by scarcity, population growth, and government support. That belief shaped financial behavior across generations, encouraging families to stretch budgets, take on long mortgages, and accept rising prices as normal. Banks reinforced this confidence by lending aggressively against property, while governments quietly benefited as higher home values boosted tax revenues and consumer spending. Over time, housing stopped being just shelter and became a cornerstone of economic stability. But that stability depended on one fragile assumption: that confidence would never break. As interest rates fell for years, borrowing became easier, prices climbed faster than incomes, and households grew increasingly leveraged. This worked as long as financing remained cheap and demand stayed strong. When rates began rising, the mechanics changed. Monthly payments jumped, affordability collapsed, and transaction volumes slowed. Prices did not crash everywhere, but something more subtle happened. Buyers hesitated, sellers resisted, and markets froze. Confidence, not concrete, began to crack. Housing relies on belief as much as supply, and once buyers doubt future gains, demand weakens quickly. This uncertainty spreads beyond homeowners. Construction slows, banks tighten credit, and governments face political pressure from both renters and owners. Housing's role as a stabilizer turns ambiguous because falling prices hurt voters, while rising prices fuel anger. Policymakers discover they cannot easily restore confidence without reigniting the problems they tried to contain. The result is a market stuck between affordability and preservation, where housing still exists, but its promise as a safe asset no longer feels guaranteed. That shift matters because when confidence fades, the system built around housing must adapt, and adaptation is rarely painless. This transition marks a turning point for households, lenders, and governments confronting financial realities ahead. If housing safety depends on confidence, what happens when belief weakens faster than prices adjust? Rising interest rates did more than make mortgages expensive. They fundamentally altered how people think about housing as a financial decision. For years, low rates created an environment where price increases felt manageable because monthly payments stayed relatively stable. Buyers focused less on total cost and more on whether they could service the loan. This mindset supported ever higher prices and reinforced the belief that housing was safe as long as credit remained available. When rates began to rise, that logic broke down quickly. Suddenly, affordability was no longer abstract. Monthly payments jumped, borrowing limits shrank, and buyers were forced to confront the real cost of ownership. Even in markets where prices did not fall sharply, demand slowed because psychology changed. People stopped asking how much a home might be worth in 10 years and started asking whether it made sense to buy at all. This hesitation matters because housing markets rely heavily on momentum. Transactions create price signals, and when activity drops, uncertainty grows. Sellers become reluctant to cut prices, buyers wait for clarity, and liquidity dries up. This standoff freezes markets rather than correcting them smoothly. Banks respond by tightening lending standards, which further reduces demand and reinforces caution. Governments face a dilemma. Lowering rates too quickly risks reigniting inflation and speculation, while keeping them high prolongs stagnation. Neither option restores confidence easily. What makes this shift significant is that it is not limited to one country or cycle. Higher rates exposed how dependent housing had become on cheap money rather than fundamentals like income growth and productivity. Once that dependency is revealed, confidence does not automatically return even if conditions stabilize. Buyers remember risk, lenders price it in, and policymakers hesitate. Housing moves from being a one-way bet to a conditional choice. That psychological shift lingers longer than price adjustments and reshapes behavior across the entire system. If higher rates changed how people think about housing, can confidence ever return without cheap money? As housing became central to household wealth, governments slowly and often unintentionally tied broader economic stability to rising property prices. Home ownership was encouraged through tax incentives, relaxed lending rules, and political messaging that framed housing as both security and success. This alignment worked during periods of growth because higher prices created a wealth effect, making consumers feel richer and more willing to spend. That spending supported economic activity without requiring deeper structural reform. Over time, however, this created a dependency. Falling house prices stopped being a normal market outcome and started being viewed as a political failure. Policymakers learned that even modest declines could trigger backlash from homeowners who made up a large share of voters. As a result, governments became increasingly cautious, stepping in whenever markets showed signs of stress. Support mechanisms multiplied, from buyer subsidies to emergency liquidity for lenders. Each intervention stabilized prices in the short term, but reinforced the idea that housing would always be protected. This protection altered behavior. Buyers assumed downside risk was limited, banks priced loans accordingly, and developers built around expectations of continued demand. Housing transformed into a policy-sensitive asset, where confidence depended not only on markets, but on government willingness to intervene. The problem with this arrangement is that it narrows policy options. When affordability collapses, governments struggle to allow prices to adjust because adjustment feels politically dangerous. When prices stay high, social pressure builds from renters, and younger generations locked out of ownership. Housing becomes a balancing act between two groups with opposing interests, leaving policymakers stuck managing symptoms instead of causes. This dynamic erodes confidence in a different way. Markets sense hesitation, buyers delay decisions, and the belief that housing is unquestionably safe begins to fade. Once confidence relies on political support rather than economic fundamentals, stability becomes fragile. Governments discover they are guarding a system that no longer corrects itself smoothly, and that realization marks a critical shift in how housing is perceived across the economy. If governments cannot let prices fall or rise freely, what does that mean for housing's future role in the economy? As confidence weakens and policy constraints tighten, housing markets increasingly respond to stress not with clear corrections, but with paralysis. In earlier cycles, falling demand would push prices down, buyers would re-enter at lower levels, and activity would gradually recover. Today, that mechanism works poorly because both sides of the market are constrained. Sellers resist lowering prices because homes are tied to long-term mortgages, retirement plans, and personal balance sheets. Accepting a loss feels like admitting failure rather than adjusting to market conditions. Buyers, meanwhile, hesitate because high prices combined with higher interest rates make mistakes costly. This standoff reduces transactions, not necessarily prices. Volume collapses before values do. When fewer homes change hands, price signals become unreliable, increasing uncertainty and reinforcing caution. Banks add to this freeze by tightening credit standards, protecting themselves from risk, but further reducing liquidity. Developers slow new projects because demand looks uncertain and financing is more expensive. Construction jobs soften, supply growth stalls, and future shortages are quietly locked in. Governments watch this unfold with limited tools. Allowing prices to fall sharply risks financial instability and voter anger, while stimulating demand risks worsening affordability and inflation. The result is policy hesitation, which markets interpret as uncertainty. Housing becomes less responsive and more fragile at the same time. This freeze has broader consequences. Reduced mobility traps workers in place, limiting labor market flexibility. Household spending weakens as people feel poorer or uncertain. Local governments collect less transaction-related revenue even as housing remains expensive. The system neither resets nor moves forward. Confidence erodes not because prices collapse, but because nothing works smoothly anymore. Housing stops functioning as a dynamic market and starts behaving like a rigid asset class, sensitive to shocks but resistant to adjustment. That rigidity makes the idea of housing as a safe asset harder to defend, because safety depends not just on price level, but on the ability to adapt when conditions change. If housing can no longer adjust smoothly, how does this rigidity affect the wider economy beyond real estate? When housing loses its ability to adjust smoothly, the effects do not remain confined to property markets. They spread outward into the broader economy in ways that are slow but powerful. Housing sits at the center of multiple systems at once: banking, consumer spending, labor mobility, and government finance. When confidence weakens, each of these channels begins to feel strain. Banks become more cautious, not only in mortgage lending but across credit markets, because housing often underpins collateral values. This tighter credit environment affects small businesses, startups, and consumers, slowing economic activity beyond real estate. Households respond by cutting discretionary spending, especially when they feel uncertain about future home values or refinancing options. That reduction hits services, retail, and local economies, reinforcing the slowdown. Labor markets are also affected. When housing transactions freeze, people become less willing or able to move for better jobs, reducing labor mobility and mismatching skills with opportunities. Productivity suffers quietly as workers stay put rather than take risks. Governments feel pressure from multiple sides. Tax revenues linked to property transactions decline, while demands for housing support, subsidies, or relief increase. At the same time, political tension rises between homeowners protecting existing values and renters demanding affordability. Policymakers struggle to satisfy both without worsening the underlying problem. This is how housing fragility becomes economic fragility. The system does not collapse dramatically, but it becomes less flexible, less resilient, and more sensitive to shocks. Growth slows not because one sector fails, but because the central asset supporting confidence no longer performs its stabilizing role. Housing was once trusted to absorb stress and anchor expectations. When that trust fades, uncertainty spreads across decisions large and small. Businesses delay investment, households delay life choices, and governments delay reform. The economy continues functioning, but with reduced momentum and higher risk. That shift is difficult to reverse because rebuilding confidence requires more than policy signals. It requires restoring the belief that housing can adapt without causing widespread damage. If housing fragility weakens so many systems at once, can any single policy realistically restore confidence? Once confidence in housing weakens, restoring it becomes far more difficult than stabilizing prices themselves. Governments can influence interest rates, adjust regulations, or introduce targeted support. But confidence depends on expectations about the future, not just current conditions. Buyers need to believe that affordability will improve without triggering losses, while sellers need assurance that value will not erode suddenly. These expectations often conflict. Policy actions aimed at helping one side can unsettle the other, creating hesitation rather than clarity. This is why housing markets can remain fragile even after prices stop falling. People remember uncertainty longer than volatility. A period of frozen transactions, failed deals, and shifting rules leaves a lasting impression. Lenders price in caution, developers delay projects, and households become risk-averse. Even when economic indicators improve, housing decisions lag because trust has not fully returned. Another complication is communication. Policymakers must avoid signaling panic while also acknowledging risk, a balance that is difficult to strike. Overly optimistic messaging undermines credibility, while blunt warnings intensify fear. As a result, public guidance often feels ambiguous, reinforcing doubt rather than resolving it. At the same time, structural issues remain unresolved. Limited supply, demographic shifts, and income stagnation continue shaping demand regardless of short-term interventions. Without visible progress on these fronts, confidence struggles to rebuild. Housing becomes less about opportunity and more about risk management. People focus on downside protection instead of upside potential. That shift changes behavior across generations. Younger households delay ownership, investors demand higher returns, and communities experience slower turnover. Confidence, once lost, does not return automatically. It requires time, consistency, and evidence that the system can absorb change without breaking. Until then, housing remains functional but fragile, moving forward cautiously rather than confidently. If confidence takes longer to rebuild than prices, what happens when the next economic shock arrives before trust returns? As confidence in housing weakens, households begin adjusting their behavior in ways that quietly reshape the economy. Buying a home stops being seen as a natural milestone and becomes a calculated risk decision. Younger households delay ownership, not only because prices are high, but because uncertainty makes long-term commitments feel dangerous. This delay affects family formation, mobility, and spending patterns. When people postpone buying homes, they also postpone renovations, furniture purchases, and other large expenditures that traditionally support economic activity. Existing homeowners behave differently as well. Instead of viewing housing wealth as a stable cushion, many become defensive, focusing on debt reduction rather than consumption. This dampens the wealth effect that once supported growth. Investors, meanwhile, demand higher returns to compensate for perceived risk, which pushes rents higher and reinforces affordability problems. Housing shifts from a confidence-driven asset to a risk-managed one. These behavioral changes accumulate. Lower transaction volumes reduce market transparency, reduce mobility limits, job matching, and productivity. Increased caution slows the circulation of capital through the economy. None of this looks dramatic, but together, it creates drag. Policymakers often miss this phase because indicators like prices may appear stable, but beneath the surface, behavior tells a different story. Housing still exists, still trades, and still supports credit, but it no longer encourages optimism. Decisions are defensive rather than aspirational. That matters because economies grow when households are willing to take measured risks, invest in the future, and trust stability. When housing loses that role, growth becomes harder to sustain. The system does not break, but it operates with lower energy and higher sensitivity to shocks. If household behavior shifts toward caution, how long can the economy function without confidence-led growth? As housing confidence weakens at the household level, the issue inevitably shifts from an economic concern to a political one. Governments rely on housing stability not only for financial reasons, but because home ownership is deeply tied to voter sentiment. When households feel uncertain about their largest asset, political tolerance shrinks. Homeowners become sensitive to any policy that might threaten prices, while renters grow increasingly frustrated with affordability and access. This creates a polarized environment where nearly every housing-related decision carries political risk. Policymakers find themselves navigating between two large groups with opposing expectations, neither of which can be ignored. Attempts to support affordability risk angering owners, while efforts to protect values deepen resentment among younger and lower-income voters. As confidence fades, political messaging becomes cautious and incremental. Bold reforms are avoided in favor of temporary measures that signal concern without forcing adjustment. This political hesitation feeds back into markets. Buyers and sellers sense uncertainty in policy direction, reinforcing caution and delaying decisions. Housing becomes trapped in a loop where political risk sustains market fragility, and market fragility increases political risk. Elections amplify this effect. Short electoral cycles discourage long-term housing strategies because benefits may not materialize before voters pass judgment. Instead, governments focus on controlling visible pressure rather than building capacity. This includes managing demand, delaying painful reforms, and framing housing as an external problem rather than a structural one. Over time, this approach weakens trust in institutions. Citizens see repeated interventions without resolution, and confidence erodes further. Housing stops being a source of social stability and becomes a constant source of political tension, affecting not just markets, but broader governance. If housing instability fuels political risk, can governments still take the long-term actions confidence requires? When housing becomes politically sensitive, long-term solutions are often the first casualty. Structural fixes, such as zoning reform, large-scale housing construction, infrastructure expansion, and productivity-driven wage growth, require time, coordination, and political capital. Their benefits are gradual, while their costs are immediate and visible. As a result, governments repeatedly postpone them in favor of short-term measures that reduce pressure without changing fundamentals. Subsidies, tax incentives, demand controls, and temporary relief programs become the default response because they are easier to communicate and quicker to implement. However, these tools rarely restore confidence. They stabilize symptoms while reinforcing the underlying imbalance between supply, demand, and affordability. Each delay compounds the problem. As populations grow or age, urbanization continues and household structures change. Housing needs evolve faster than policy responses. Markets sense this gap. Developers hesitate to invest when rules are uncertain. Households delay decisions when outcomes feel unpredictable. Financial institutions price in long-term risk. The longer reforms are delayed, the more disruptive they become when finally attempted. Politically, leaders justify delay by pointing to complexity, fiscal constraints, or external shocks. But over time, voters recognize the pattern: repeated intervention without resolution. This erodes institutional credibility and deepens skepticism about housing promises. Confidence cannot return when solutions remain theoretical. Housing stability requires visible progress, not just management. Without it, markets operate in survival mode rather than growth mode. Long-term solutions are delayed not because they are unknown, but because implementing them demands confronting trade-offs that short-term politics prefers to avoid. If delaying reform keeps increasing the cost of action, what happens when postponement is no longer an option? Eventually, housing reaches a point where it no longer functions as a foundation of confidence, but as a source of uncertainty that shapes decisions across the economy. This moment is not marked by a dramatic crash or a single policy failure. It arrives quietly when households stop assuming stability, investors demand protection rather than growth, and governments focus on containment instead of progress. Housing still exists, prices may remain high, and transactions continue, but the underlying promise has changed. What once felt like a reliable anchor now feels conditional. This shift forces a broader reckoning. Economies built around housing-driven wealth effects struggle to generate momentum when that engine weakens. Growth becomes harder, inequality feels sharper, and political tension intensifies. Policymakers realize that protecting prices alone cannot restore confidence, but rebuilding trust requires addressing deeper structural issues that were postponed for years. The task is slower, more expensive, and politically riskier than managing symptoms. The final trade-off becomes clear. Either housing is allowed to adapt through reform, investment, and adjustment, or it remains frozen in a fragile state where safety is assumed but never fully believed. This is not a choice between collapse and stability, but between stagnation and resilience. Housing did not fail because people lost faith without reason. Confidence faded because the system stopped aligning expectations with reality. Restoring that alignment is the real challenge ahead, and it extends far beyond real estate into how governments plan, how economies grow, and how societies measure security in an uncertain world. If housing can no longer guarantee safety, what asset or system will societies trust next? For deeper explanations on how global economies, housing, and policy shifts connect beneath the surface, stay with the channel.